Hello and welcome to CMC Markets Weekly Trading Outlook for December the 21st, 2015. My name is Colin, Chief Market Strategist. Our theme this week is Outlook for Trading Trends in 2016 for Indices, Commodities, and Foreign Exchange. We're reaching the end of the year here, and we're into the last 2 weeks, which are broken up by the Christmas and New Year's holidays in North America. We also have we do have a number of data points, but overall it's fairly common with a lot of people away during this 2 week period for things to go a little bit quieter in the markets. We'll see if we do manage to still get a Santa Claus rally this year. Historically, markets have done well after the Fed has made a hawkish move in December, so we'll see. I'll just talk a little bit to some of the highlights of the next couple of weeks, and then I'm going to talk to some of the trends we might see emerge for markets in 2016. To begin with, it's relatively quiet to start the week. Tuesday and Wednesday are busy. On the 22nd, we get GDP for the U.S. and we have a central bank meeting in Turkey where a half-point increase is expected. Now I'm going to talk to this a little bit more in later on in this video, but we are at a point where it seems as though we've gone from the extremes of dovishness and started to move our way back with towards hawkishness. The Fed, in a way, has almost opened the floodgates for central banks to start raising rates once again. On Wednesday the 23rd, we have GDP reports for the UK, Canada, and France. We have retail sales for Canada, and we have a number of key announcements for the United States, including durable goods, personal income, new house sales, consumer sentiment. On the 24th, we get jobless claims. We also get half of Japan's monthly big basket of data: unemployment, inflation, leading index, housing starts, construction spending. That's on Christmas Eve. And then the following week, on Sunday the 27th, we get the rest of Japan's data: retail sales, industrial production. On the 31st, we get Chicago PMI and we get China manufacturing PMI, and then things pick up again in the new year. So moving on now to our 2016 outlook, I thought I'd start with global stock markets. And the most interesting thing I think we'll see this year is in the U.S. with the Fed starting to raise interest rates. We've been in a sideways market for much of 2015. Through this transition from easy monetary policy to the Fed going from full tilt on the gas to starting to ease their foot off the pedal and going back towards a more neutral stance on monetary policy, neutral being interest rates in line with inflation. And the Fed appears to be starting to head that way. Historically, what that's meant for the economy is that you've had some rough markets before the Fed starts raising interest rates, but then after they've started raising interest rates, stock markets have tended to do well. The reason for that is that the Fed raises rates when the economy is good, when the economy is growing and the outlook for corporate earnings is positive. That's usually good for stock markets. What did we see around the Fed meeting? We saw stock markets rally for a couple of days ahead and for a day afterwards before they started to correct back. So what are we looking at here? I've brought up the market for the last 3 cycles here, looking at the S&P on a monthly chart. And what you often get is you'll get a rally up off the bottom, what I call the mid-cycle consolidation, which is when you start to transition from easy monetary policy and high liquidity to neutral and then on to more hawkish monetary policy. And as you can see, for example, in 94-95, the markets went sideways for a year and then blasted off. And similarly here, after the 2000 to 02 bear market, you had a rally. The markets kind of went sideways for the better part of a couple of years and then blasted off. And then similarly again, then after that, so we've had a bit of a pause here in 10-11, and we rallied again. The big question is now for us as I look at this chart is this the mid-cycle consolidation where we're ready to blast off again, or could we start to roll over, or could we spend another year going sideways? Now there are a couple of other things. 2016 is a presidential year. Commonly markets have done well in year 4 of presidential years. Although in this century, the year 8 of a presidential cycle, where the president had won re-election and got to year 8, have struggled. 2000 was a struggle year for the markets. 2008 certainly was one I think most people, at least the bulls, certainly would rather forget. So It's an interesting point as we head into 2016. If we look at years that end in 6, 96 was a positive year, '06 was a positive year. So '16 also. Generally speaking, the indicators, cycle indicators and things seem to be suggesting we should have a good year for 2016. I'm thinking somewhere a 10 to 20% gain for the S&P is definitely a possibility. But there are some things technically that suggest maybe it might be a little bit less. Perhaps some of this cycle got front-ended through the big QE-driven markets of 2012 and 2013. We'll have to see. So if we blast through this 2130 here, off to the races, and we could probably see a 10% gain, take us 2300, 2400 on the year. Otherwise, if we see it drop back, first support 2000, 1900, this 1785 level here, the 23% retracement of the trend off the '09 low would also be a significant test. And we're watching here on the RSI. We had been overbought on the RSI. The consolidation of the last year has eased the overbought conditions. The question is now, do we level off here and go back into a more moderate uptrend, or do we keep on going down? My suspicion is we'll probably level off and then can start to work our way back up again in 2016. We have seen improvement in the economy in Europe. There's signs of improvement perhaps in Japan, or at least expectations of improvement in Japan, and also in China as well, as could still struggle, though it's going through a fairly big transition process. So that's the outlook for indices here. I think we'll probably get a pretty good year in 2016 for indices, but there are a couple of possible yellow flags out there suggesting that it might not quite be as big as we would think. But so far, look, even at a 0.5%, the Fed is still very accommodative. A number of other central banks are still very accommodative, and I wanted to talk about that as we move on now into the other parts of the market. I wanted to take a moment and talk about central banks. So we've got here, we've reached the end of 2015, and for most of this year, central banks were in full easing mode. Many central banks around the world cut interest rates this year. The ECB brought in a quantitative easing program. The Bank of Japan kept theirs going, but now that we're reaching the end of 2015, it's like we've gone from we've reached the point of as a pendulum where we go back and forth between hawkishness and dovishness. And a few years back, many years ago, we reached hawkishness, and then we've been dovishness, and then this year in 2015, I think we've reached the extreme of dovishness, and we're just starting to come back the other way and start to work our way back towards neutral. And the reason I say that is a fewfold. First of all, as we got to the end of the year, fewer central banks were cutting interest rates. The Fed signaled after their October meeting and really at their September meeting that they were going to start raising interest rates by December, which they did, and kind of gave any central banks that wanted to do any more stimulus one last round to do so. Not very many central banks took them up on it. In fact, in early December, obviously the ECB came out with some more stimulus, but it was a lot less than people were hoping for, and the euro started going back up again. The only other major central bank that cut rates in December was the RBNZ. Now they had one to go. They had raised rates 4 times in 2014. They cut 3 times in 2015, and then they just finished their job and went to neutral at the end in December. Going on, you had other things like Norway had been expected to cut rates and didn't. The Bank of Japan, they're meeting this month. They just made some adjustments to their QE program, but they didn't really increase it, and that kind of disappointed the market, and that has the yen starting to pick up again as well. So what are we seeing? We've probably reached the point of maximum dovishness starting to go back. What does this mean for world markets? Well, the US dollar has probably also reached its peak for now and has started to roll over. Other currencies have probably reached their lows and maybe starting to bounce back. And if we see the US dollars start to ease back, that takes off some of the pressure that the corporations have been under, lifts one of the caps that's been depressing corporate earnings in the States, and could help their market to rebound, and that also could support a higher stock market in the United States in 2016. So a lot of moving pieces and a lot going on. But just to see, not only did we get after the Fed meeting, Norway decided not to cut rates, but we're also starting to see other central banks follow suit. So, and especially some of the closer ones, Hong Kong Central Bank, who maintains a peg with the U.S., as soon as the Fed raised interest rates, a couple of hours later, Hong Kong raised interest rates. The day after, Mexico raised interest rates. So it's almost as though there's a number of central banks that have been out there waiting to see what the Fed would do, and would they finally start to raise interest rates and now that the Fed has done so, it's opened up the gates for everyone else to do so. So the other big one we'll be watching this year is the Bank of England. A lot of people, the UK economy has been doing very well, and a lot of people have been wondering when the Bank of England would start to raise interest rates. Well, we might get a better idea from them in January or so when they're planning on doing it. My guess is that they'll probably raise rates twice in the UK in 2016, once in the spring and once in the fall. My guess for the U.S. is that they'll raise rates 3 times in 2015. The Fed is currently calling for 4 rate increases, which is 1 per quarter. I'm thinking they'll raise rates in March, in June. They'll skip September because of the election, and then raise again in December. Possibility that December one may or may not happen, depending on what happens with the election results. But that's the schedule I'm kind of thinking for the time being. And this is what's important is also that is less aggressive, perhaps, than I think the market has priced in. In the past, the Fed would raise rates every single meeting when they went on a campaign. The last time they did it for about a dozen meetings over a course of a year and a half, and they just went. This time it's going to be like up and wait and see what happens, wait and see what happens, wait and see what happens. And then by the end of 2016, a year from now, then we'll probably be starting to look at what's the Fed going to do to run down their balance sheet. But that's a year from now, and a lot can happen between now and then. We'll see. But that's what things are looking at here from the end of 2015. So, what does this mean for markets? And where I'm going to start with is start with gold and currencies here. So gold has been in a bear market for the last couple of years. As the US dollar, which has had a big appreciation over the last couple of years, the gold, of course, is the other side. The US is the premier paper currency, gold is the premier hard currency. So, when as the US dollar has been going up, gold's been going down. But what's more interesting lately here, we're looking at almost a double bottom in gold here, and gold has not gotten down to 1,000. It's been drawn closer and closer to 1,000, hasn't gotten there. What have we had? Gold had gotten oversold, and in fact the momentum starting to turn the other way. As I think the US dollar has peaked, with the dollar index peaking about 100, and even after the Fed meeting, when people had a chance to have another go at 100, it's topped out short of 100. It's not getting there, and it does look like there's a fairly significant top forming in the US dollar index. Similarly, I think we've got a nice bottom starting to form here in gold, and I think one of the big stories we'll see of 2016 is the US dollar starting to give back some of its gains of the last year, and other currencies starting to come back. Gold being one, but also I'll show a few other currency charts here. Let's take a look at the euro dollar. And look at this. So again, euro had been in a downtrend. We got this big spike on what happened here. The ECB wasn't as dovish as people thought. Boom, $1.05 to $1.10 in a day. Massive, massive move for a currency. And now we're just digesting this gain, 108 to 110. As long as we continue to hold this 108 previous breakout point, it's acting quite well here. And we could still see the euro continue to appreciate over time. We'll look also at cable. And sterling also has been weaker here. It remains in the downtrend, and I think, but at the other hand, you've got this big positive RSI divergence, so your downtrend is slowing. At some point, this could turn, but I think what that's waiting for is some kind of more serious signal from the Bank of England that it's been getting ready to raise rates. Governor Carney's actually been talking more dovishly lately. I think that was because he was trying to keep the currency under control in case the ECB went uber dovish, which they didn't. So between the ECB not as dovish and the Fed now having raised interest rates, there does appear to be some room for the Bank of England to raise rates sometime in 2016. And I think they'll go for 2. That'll take them up to a 1%. 3 rate hikes for the U.S. would take them up to 1.25%. And I think that's the neutral rate you're going to see this cycle for a lot of central banks, is around 1, 1.25, 1.5. When the Bank of Canada raised rates in 2010, they went from 0.5% to 1% as an example. And then they gave those back in 2015 when the oil price crashed, and they had the advantage of having some arrows left in their quiver to be able to do that, which is why the Fed and the Bank of England in particular are in a position where they probably need to reload over the course of the coming year. Speaking of the Bank of Canada, let's bring up dollar CAD, which has some very interesting trading going on here today. Look at this. This is potentially a big reversal here, and here's why. Big run up in dollar CAD. It's run into $1.40, did not get through, and it's getting knocked back. Massively, massively overbought. I think we're seeing a washout here on the Canadian dollar, and we could be starting to gear up for a potential rebound where this thing could come back initially back around 130, but there's room for more. But anyways, dollar CAD is one that does look like it's peaking a little bit here. And so then I've talked about, I also want to mention with relation to dollar CAD, let's also take a look at dollar yen. Dollar yen is also showing signs of topping here. Look at this. It's been basically going sideways since June, but it has been quietly rolling. It had been rolling over, came back up here on the spec when people started to think, yes, really, the Fed's going to raise interest rates. But look, it hasn't kept on going up. And then here, the day the Bank of Japan disappointed, bang, it's starting to get knocked back down as well. This shoot up here was on the Bank of Japan had announced they would be buying some more ETFs, but then they also made other adjustments. So that said, and they came out and said that these were adjustments. It's not new stimulus, and bang, the yen came back down again. So we've got this head and shoulders top here on the RSI, triple, almost a quadruple top here on the pair, and it looks like it's starting to roll back down, busting this trend line again, and RSI going under 50. So we could see in 2016 the yen start to work its way back down the other way as well. Initially, was support would be around 120. We'll keep an eye out for that one. And just one more currency I'll show the Aussie dollar. And then I'll do crude oil and we'll wrap up. So just the Aussie dollar here, another example of this had been really depressed with metal prices and energy commodities getting hammered through this back half of 2015. Positive turnaround in momentum on the RSI. This is a really nice ascending, almost an ascending triangle base forming here in it. In the pair, and definitely showing signs of base building. So as other currencies, base building, U.S. dollar peaking. And finally, I'm just going to wrap here with crude oil as soon as it lets me. And we'll do WTI here. Last one. Here we go. So what I wanted to show here, first of all, is we're getting oversold on WTI and we're hanging around this $35 level. 34, 35 has been the support zone. If it busts 34, we're in big trouble and oil could head lower. Oil's been in a big downtrend. Why? Well, we've got this huge supply war going on among producers. OPEC had a meeting and they couldn't really come to an agreement on production. Saudi Arabia and Iran are at loggerheads in many areas and can't agree on anything. You've got they're trying to hold their market share against emerging producers like the U.S. shale business and oil sands in Canada and other things, and of course Russia's also in there as a big producer as well. And right now there's a lot of oversupply in the market. If global economy improves, that can improve the demand situation and sop up some of this oversupply. But for now, the big question is what level of pain is it going to take for Saudi Arabia and some of the other big producers to actually start scaling back production? We may not find out for a while. The next scheduled OPEC meeting to discuss this is in June, and although there's always the possibility they could have an emergency meeting sooner if they really needed to, but it's still a case of what's really happening there because of all the uncertainty. The price could still work its way down. It's trying to bottom out here. I think we could get a trading bounce, maybe back up into the high 30s, maybe even 40 at some point, depending on if things turned a little bit. But even getting back to up here to 50 could be a bit of a struggle for crude oil. Although anything's possible, really. The other thing I wanted to just show on crude oil is the big long-term chart here, just to give us a better idea of where we're at. So, we've come back down here, and look at this plunge here. It's just like that one. We've come back, and we're retesting the 2008 lows down in here. And it remains to be seen if these will hold or not. If they don't hold, then our next support is in at around 32.30, and then this here is around 25.75. What I think might happen is at some point you'll probably see it plunge. You could see it plunge into the 20s. Whether it bottoms out at 30 or 25 or 20 is anybody's guess. And I think to think otherwise is you're just going to end up pulling a number out of the air. But I think you could see at some point when it does get washed out and stays down, it probably won't stay down very long. The other interesting thing about crude is this. Look, when it had this big plunge here, right, only a little bit oversold. We're much more oversold now than we had been in the past. And there's a big positive divergence here. So while there's talk of could oil go below 30, on the other hand, the technicals are telling us oil could be setting up for a big rebound. So maybe 40 and 50 aren't necessarily unrealistic, but it depends. The question is, what would it take to spark a rally? And that's the big unknown, and that's the thing we'll be watching for into the first half of 2016 for crude oil. Or similarly, what would it take to spark another down leg? So in the London markets, it looks like we're getting extremes. It looks like 2016 could be setting up for some big trend changes where trends that had been up might shift to down, trends that have been neutral might shift to up or down, and so on. But overall, it does look like we could be heading for another big and active year for trading, with a lot of large trends for people to take potentially take advantage of, as well as reversals. This is my last video for 2015. We'll be off for a couple of weeks now, returning on the 8th of January in 2016. So I'd like to wish everyone a Merry Christmas and Happy Holidays.